Hello. In this video, we'll continue with our gross income problem set, and we're looking at problem 13. Tangerine owns many houses, and Tangerine rents out these houses. Now, there's one house that Tangerine specifically owns. So Tangerine owns this specific house, which has a fair rental value of $1,500 per month. She allows Pear to rent the house for $1,000 per month, even though the fair market value is $1,500 per month, as long as Pear agrees to pay for any repairs herself and to perform all upkeep of both the house and other property owned by Tangerine. So the idea here is that, and let's just see what's going on, right? We have Tangerine and we have Pear. So again, whenever you have something this complicated, it always helps by starting off writing out what's exactly going on. So Tangerine provides to Pear a house with a rental value of $1,500. Pear pays cash of $1,000 per month, right? This is all per month. And also, Pear performs, or potentially repairs the house and performs upkeep on house and other Tangerine houses. So we have $1,500 house, $1,000 cash paid, and then we have this other item that Pear is with respect to potential services and actual services going on. Now, it's important to understand there's nothing in the facts that makes us think about special relationships. That's usually when you see something that's, that's a lower amount, the first thing you should do is look at special relationships, which we talked about in earlier videos. Are they an employee-employer? We're not told. Are they family members? We're not told. And are they business owner and a business? No, we're not told that. So let's go ahead and we're going to assume that these are arm's length. They are arm's length parties to this transaction, which means that they are not related and do not have a special relationship in any way. Okay, so we're focusing on gross income here. We're focusing on gross income. And whenever we have gross income, we're focusing on income tax. We have 5 questions, right? First question is there any income? Second question is there any deductions or credits? Third is, when do we have those items? Fourth is, who has those items? And fifth is the character. So we're looking at gross income, so we're focusing on really 3 questions. What amount of gross income, if any? When is there gross income? And who? So the when question, we're just dealing with the same tax year, so it's all within the same tax year. It's not like we're told there's multiple tax years involved for either party, Tangerine or Pear, which are both individuals. Who? So with this item, we potentially have both parties we have to concern about, because Tangerine is getting cash and services, and then Pear is getting a house worth $1,500, but Pear is also performing services. So we have to look at Tangerine and we have to look at Pear as well, and we have to look at them separately with respect to whether they have gross income. And then we're looking at whether we actually have gross income and what amount. So if you recall, when it comes to gross income is defined in the Internal Revenue Code under Code Section 61 as income from whatever source derived, very broad. Specifically though, Glenshaw Glass provides us some guidance and says that gross income is an undeniable accession to wealth, which means our net worth, which are assets minus our liabilities, has increased. There's been a realization event, which realization event deals with, is there a legally severable event where it's separate from the activity that created the income? And then third is there's dominion and control, which means there's no strings attached. There's no, items that say, you can't use the money in a certain way or you're restricted in some way. So there's no strings attached. So we have to look at these parties separately, but we also have to worry about them kind of together because, again, they're arm's length. So the first thing I want to do is, since they're arm's length, remember, when you have an arm's length party, the fair market value should equal on both sides. So we're looking at the monthly payment, right? And we have $1,500. That's the value of the house. Pear is paying $1,000. So Tangerine, where's Tangerine getting the other $500? Well, we're told that Tangerine gets this potential repair of the house and then upkeep on the house and other Tangerine houses. So this is implied. This is implied to be worth $500. Implied. Why? Because $1,500 on this side has to equal $1,500 on this side. When the parties are arm's length, when they're unrelated, has to, from a tax standpoint. So this is worth about $500. All right? So then we go through our Glenshaw glass, and let's start with Tangerine. So Tangerine is renting out this house, and before the rental, Tangerine does not have the cash and the services, right? After, Tangerine has the cash and the services. So one thing to understand here is that if Tangerine did not have this house that was involved here, which remember we talked in previous videos about the idea of barter exchange. Barter exchange is when you have something other than cash, like a service or property that you can give in exchange for the actual for some other type of property or services. So barter exchange deals with property on services on either side. So here, Tangerine has property for cash and services. So this portion here and here is a barter exchange. The cash is not. That's easy to see. It's gross income, right? We're going to go through the steps. But what about the barter exchange? Property and or services on either side. On this side or on this side. And we have both. We have property here and we have services here. So that's a barter exchange. And the idea, and you can go back to previous videos where we talked about barter exchange, the idea is that if Tangerine did not have this property and Pear performed the services, Tangerine would pay Pear $500. And Pear would have to recognize that $500. And on the other side, if Tangerine, if Pear didn't have services that Pear could pay, or then Pear, if Pear did not have $500 in services that Pear could pay, then Pear would have to pay $500 cash for that portion of, to make up the other $500 missing. And then Tangerine would have to record that $500 as a result of the rental. So that's what the barter exchange is. What the best way to think about it is, if there wasn't the property or services and you paid in cash, what would happen? And it would create income because you would have an asset, cash. So cash goes up by $1,500 both directly and implicitly. Well, for Tangerine, it's $1,000 cash actual, but then it's $500 implicit cash. See that? That's implicit, and that's where the barter exchange idea comes in. So we do have net worth, an increase of $1,500 in assets, so that the net worth is there. All right, what about realization? Well, the realization is Tangerine owns the house before and after, and then there's this rental that comes off it. So, and we saw this in a previous video as well. So the realization is a severance or separable rental amount from the house. And then dominion control, okay, well, are there any restrictions on the services or the cash? No, they have to take place. So therefore, Tangerine has to record $1,500 of gross income, which is basically the fair rental value of the house. Now, Tangerine only got $1,000, but Tangerine got $500 in services, and it's exchanged for the house, so it does create. So Tangerine has to include $1,500 in gross income per month, so times 12, that's $18,000. So $18,000 is included for the year, because let's assume this went for January 1st to December 31st, in the gross income of Tangerine. All right, well, what about Pear? So Pear, we go through the same analysis. We go through the same analysis for Pear. We go through elements 1, 2, and 3 as well. Now, we're looking here, and Pear is paying cash and also performing services, and in exchange getting this house. So simply, the payment of the $1,000 cash for a house, when you buy something, that's an outflow. that's not an issue of receiving, getting a gross income, having gross income, because that's an outflow. But what about the services? So the idea here again is that when we apply the barter exchange rule, it's as if Tangerine paid cash for the services. So assume there is no house. If Pear performed services, let's say on other houses that Tangerine owned, and this was not being rented out to Pear, then Pear would, and Tangerine paid in cash, Pear would have to record that $500 in cash. And then assume that we take that implicit $500 in cash and Pear turns around and then uses it towards the house. So that's the idea here, is that that $500 per month is of services potentially is gross income. So that net worth going up, it's the implicit $500 in cash. So there's an increase in $500 per month of this implicit cash, which is an asset. So yes, we do have net worth increase. Second is realization. The realization is service. Pear is providing a service, potentially repairing the house, and also upkeep. The upkeep is for sure, so we do have services. And remember, services are always severance because they're separable from the actual service, and again, the implicit cash. Third is dominion control. Are there any restrictions on the use of the house? No, for that portion or the cash that will be received. No, so there is dominion control. So that means that Pear has to include $6,000 is included in gross income to Pear for the year, $6,000, which is $500, that implicit from the services, times the 12 months, which is $6,000. So to summarize this, there's a barter exchange element going on here, and we had to break it up with a portion cash and whatnot with the house. Tangerine has to include $18,000 during the year, $1,500 per month. $1,800 is included over the entire year on the tax return. And then Pear has to include $6,000 because of this service element that takes place.